Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows initially for the conventional fund business for the week ended November 6, 2013. I don't think anybody would be real surprised after we hear that the Dow hit, all-new time high on this last Tuesday, that investors injected about $8.6 billion into the mutual fund arena. Now, that said, though, there was actually some concerns out there. Actually, we had some good news this week. We saw ISM numbers, both non-service and service sectors, do fairly well. But people were sitting on the sidelines, content to wait to hear what the ECB would do with cutting its rates, what the GDP comes in as. Of course, one of the big numbers everybody's waiting for is non-farm payrolls that actually came out this morning with some good news. But that didn't impact the flows this week. Let's go ahead and take a look, though, at the news and what it did to our macro groups. We saw equity funds took in about $3 billion in net new money. Taxable bond funds saw about $1.3 billion enter their coffers. Muni bond funds continued to just get a black eye, about $800 million in outflows there. And money market funds certainly saw some good inflows, about $500 billion in net new money entering their coffers. You know, as we take a look and start moving towards the equity side of the arena, we again focus on the good news that came out. ISM numbers, both on the retail space and on the, service and non-service space, both came in fairly strong, and I think that was things that people thought were good, and also people anticipated, I think, this week that we were going to have a good results from the ECB cutting rates. And of course, we found out yesterday that was the case, but of course, people were trying to front run that a little bit. Let's take a look at equity funds and see how they fared, though. Equity funds actually lost a little bit of money this week. They were down 0.24%. For the first week in four, we actually saw negatives out of this group. But again, they took in about $3 billion in net new money, and this is the fourth consecutive week that we've seen net inflows into this group. Year to date, that brings the grand total $167 billion in net new money coming to the coffers, again, ex-ETFs. That's a very important figure. Now, if we take a look at domestic equity funds, they only took in about $700 million this week, and it was the fourth consecutive week they've had positive flows. But for the 23rd consecutive week, we saw non-domestic equity funds taking a big chunk, $2.3 billion of money going to those coffers. You know, and as we break these out, it's nice to look at where the money went for each group. So on the non-domestic side, we saw large cap funds actually, once again, taking in money, about $600 million net new money coming to that. So really, that was pretty much the lion's share that came into the to the domestic side. However, if we take a look at non-domestic side, we did see kind of an increase going in emerging markets, so about $800 million net new money going to there. But overall, $2.2 billion came into the international part of the international fund arena. So international equity funds were actually doing well. International includes emerging market, includes Latin American funds. So country-specific, region-specific, and also all our international. Really what's missing there is global funds. That's the only thing that's missing. But that was some good numbers. But again, if we take a look at emerging markets gaining some interest, this was off of some good news from China, doing better than expected, and also India doing better than expected. Well, let's see how that panned out and played then for our ETF arena. So on the ETF side of equity funds, we saw for the first week in floor outflows. About $5 billion of money exited the coffers there. iShares Core S&P 500 fund, though, took in $2.8 billion, very respectable. iShares MSCI EFA funds actually took in about $1 billion. There's people doing that kind of front running, anticipating that the ECB would actually cut rates, which again they did. But where we saw money leaving the coffers of this big group, SPY saw $4.6 billion outflow. That's huge. iShares Russell 2K, both of these have been on either the top or the bottom just about every other week. $2.5 billion exiting from their doors for the week as well. Well, this brings us then back to the income play. Fixed income funds actually saw a unique piece again. For the third consecutive week, we see inflows, about $1.3 billion enter their coffers. And for the first week in four, though, we saw negative returns. Negative 0.14% wasn't that much to write about. The big winner this week was corporate investment grade debt funds, saw about $1.6 billion enter their coffers. Flexible bond funds took in about $0.3 billion. But on the flip side, we still see government mortgages getting hit, $280 million in outflows there. And corporate high yields, with people kind of being a little bit iffy on the equity markets, not surprising there to see outflows about $201 million. Not a lot to write about. Well, now let's take a look, though, at what happened on the ETF side of the arena for fixed income funds. They saw about $400 million in outflows. iShares 20 plus Treasury basically saw about $420 million of inflows, very strong for them. 1 to 3, actually the iShares 1 to 3 credit bond fund actually took about 140. And then at the bottom of this group, we're seeing high yield, very much like the open-end fund group. People kind of stepping away until they find out what's happening with the non-farm payrolls and GDP, US GDP and the like. So we saw iBox high yield corporate shares actually losing about $480 million. Well, that would bring us to the pariah of the group, and it certainly has been. For the 24th consecutive week, we've seen outflows out of this group. $778 million coming out of muni funds. That's certainly a big number, and it's the first week in 3 actually that we've seen negative returns. Now, if you look to the far right of the slide, it's only 0.04% negative return. So really, we do think there's some probably buying opportunities. But again, I think people are sitting back and kind of waiting to see what the market's going to do, what the ECB was going to do. And also, we're a little bit concerned that the Fed has got and put the idea of tapering back on the table maybe by the end of this year. I think most people are still betting it's going to be 2014. Well, let's go ahead now and move on to a different area, and that's the money market arena. As we tell you many weeks, money markets do not necessarily run any trends that we can find. We have corporate treasurers moving money in and out. We have retail investors getting scared, parking their money. Well, this week we saw for the 3rd consecutive week $5 billion of net new money during their coffers. And how it broke out is taxable money market funds put in about $2.8 billion. And how it broke out here was really the big institutional players. They added $2.6 billion coffers, and we saw retail investors add just $200 million to the coffers of money market funds. On the tax-exempt side, though, we've actually been watching some negative numbers arrive, but this time for taxable money market or tax-exempt money market funds, we actually saw about $2.2 billion in net new money enter their doors. Well, as we wrap this up for the week, one of the 2 things that actually came out, I've mentioned to it already, non-farm payrolls came in actually very strong, 204,000. I think the estimates out there for most analysts was right around 120,000. So really very strong, 204. And also we saw that the ECB did cut their rates, and this was actually good news for a lot of people that were investing in the European community. Might say that the government's still concerned, but it certainly adds a little bit more liquidity in the market, and it makes it so that just like in the U.S., people are going to probably be pushed a little bit more towards equity type of products. Well, this week I'm actually trying to do my contribution to Movember. I've got this weak mustache that I put on my face. Hopefully 2 weeks from now when I see you guys again, it'll be a little bit stronger in there, a little bit thicker. Again, Movember is actually just a reminder for men to pay attention to men's health, and that's what this month is representative of. Well, until next time, my name's Tom Rosine. I'm wishing you the best in your wealth planning and creation. Thanks for joining us.